Hi, everybody. I'm Brittany Lewis, a breaking news reporter here at Forbes. Joining me now is Steven Ehrlich, Director of Research for Digital Assets. Steven, thanks for coming on.
Thanks, Brittany.
You have some news. You wrote a piece with the first part of the title being How to Get Rich in Crypto. And this is really interesting because it really hasn't been a good year for crypto. So before we dive into the piece, can you give us the landscape here and talk about how crypto is struggling?
Right. So it's a very interesting time for crypto. I mean, actually, 2023 has been relatively good for crypto, but only because 2022 was so painful, where you saw the prices of assets like Bitcoin and Ether, and then some of the more fringe assets fall anywhere between 60 and 90% year to date. I mean, I think Bitcoin's up about over 50% this year. Ether and others are similar, but again, it they haven't come close to making up what was lost during the bear market of last year. And with that said, most of the crypto companies out there that sort of track the space have had very difficult times. I mean, exchanges like Coinbase in particular, that's one that we focus on because as a publicly traded firm, they have to release quarterly audited financial statements, and I mean they've had to take massive losses, nine-figure losses. A big part of that is because of the fact that trading volumes are directly tied to price appreciation, volatility, and when interest goes down, so does the so does trading activity on the exchanges. And then out of all that comes this company called Tether. Their business model is actually very, very simple. All that they do is take a dollar bill from a customer, create a digital replica token that goes on top of a bunch of different blockchains, and then and as a way to sort of synthetically create dollar liquidity, which is a key source of plumbing for the entire crypto trading ecosystem. And then they invest those dollars into relatively safe assets like treasuries, money market funds, repos, things like that. And given the rising interest rate environment that we're in right now, they're sitting right now. Tether is sitting on about an $84 billion pile of dollars that are essentially an interest-free loan that they invest in these assets that pay about a 5% return. And right now they're on course, according to our estimates, to make more than $6 billion in operating profit this year.
That's incredible. I mean, that number, I was just trying to write it down. I mean, that's eye-popping. So, are there any other companies out there in the crypto space that are following this profit-making, blueprint?
Yeah, it's a good question because again, Tether's business model is relatively straightforward. I mean, their product is not barriers to entry are relatively low. Their product is not that unique. I mean, Tether was kind of the first out there. They launched all the way back in 2014, but it wasn't really until the COVID-driven boom that they surged. I mean, they used to be in the single-digit billions, and again now they're around $84 billion. And there are other companies that have tried to replicate this product and this success. Probably the biggest and best known is Circle, which is based in Boston. And I think right now they have about a $28 billion market cap, at least according to the circulating supply of their token called USDC. And actually, up until I would say about a year ago, they got pretty close to actually catching and perhaps passing Tether. I think around then, Tether was around 47 billion, Circle was around 45 billion. But those companies have gone in divergent ways since then. And then this really kind of came to a head in March when the collapse of Silicon Valley Bank came, and it turned out that Circle, which is seen as sort of the regulatory compliant friend of the industry exchange, whereas Tether has sort of they're based in the British Virgin Islands, and they've always kind of shunned regulatory scrutiny and have a relatively opaque operating model. Circle turned out to have $3.3 billion in unsecured loans held at Silicon Valley Bank. So when that bank collapsed, and FDIC insurance, at least until the Fed, the OCC, and the FDIC came in and just guaranteed all deposits, they were looking at a $3 billion hole on their balance sheet, and that caused billions of dollars in USTC holders to sell that asset and go into Tether, just because even though Tether is somewhat shadowy, they don't disclose all of their banking relationships. At least one thing that is pretty certain is that they don't bank in the United States, and at that point, being able to sort of inoculate yourself from being exposed to the U.S. banking system was helpful. Circle, I think we estimate that they're on track to make somewhere, I think around like $1.6 billion in revenue or profit. The two numbers are similar because the overhead in running this business is not extremely high, but of course, there's other expenses such as operating and R&D and so on and so forth. But again, it does not seem like anyone is remotely close to where Tether is, especially in this ecosystem. And although we'd have to do more research to kind of prove this or verify this, there's a good chance that Tether is the most profitable company in crypto right now by a relatively large margin.
Something that you said that stuck out to me was that Tether is somewhat shadowy. And when I'm thinking about where I want to put my money, it's not somewhere shadowy. So how is this allowed?
So it's allowed because it's hard for one regulator, especially for a company like Tether that operates around the world, to sort of um, get dominance. I mean, Tether has run into regulatory troubles in the past. They've been sued by the CFTC. They've had to settle with them because one relatively infamous incident back in 2019, Tether's sister exchange, which shares the same leadership hierarchy as Tether, had $850 million in customer deposits locked up at a payment processor that was kind of seen as also shady, called Crypto Capital. And they borrowed $850 million of collateral from Tether to help make sure that the exchange, called Bitfinex, would be able to meet customer withdrawals. I mean, that's a very big no-no in the world of stablecoins, which is what Tether is, because collateral is supposed to be sacrosanct and never used for any purpose other than being redeemable for users if they want to trade in those tokens. So that's just one example. But again, they've never provided a definitive audit. Oftentimes they claim but they've never provided the definitive audit. And oftentimes when they get criticism, and there's a lot, I mean, there are some very public short firms out there that are shorting Tether. There's been lots of investigations into Tether. We did a profile on them back in December, and they also make the argument that people think that because they are so successful, that no matter what they do, someone's going to find a problem with it. The goalposts are always going to move, and all of Tether's top four executives are European. Most of them are Italian. And Paolo Arduino, the chief technology officer who spoke to us for the profile we did back in December, basically said something akin to the belief that because they did not go to Ivy League schools and because they didn't grow up on Wall Street, they don't know what they're doing. Whereas if you look at the great financial crisis and some of the other major crises out there, they were all created by Wall Street types. So they certainly think that there's a bit of a double standard. But that said, there's certainly much more that they could do as far as disclosures if they wanted to prove themselves to be completely transparent. To be fair to Tether, though, there have been for years short sellers and critics saying that it's all vaporware. They're minting these tokens without accurate collateral. They've done, and that at some point it's a house of cards. It's all going to come falling down. But they have passed every single test that they ever faced. A big one happened in May of last year when a $45 billion stablecoin ecosystem called Terra Luna crashed, and Tether had to process $16 billion of withdrawals in a matter of days, and they did it without a hiccup. Then when FTX collapsed back in November, they had to process billions of dollars in withdrawals again. No issues. And those were two periods where a lot of the critics were sort of circling in, expecting Tether to be the biggest domino to fall, but it never happened.
Executives at Tether are saying that the goalposts are always moving. And you and I have talked about a lot how crypto is almost like the Wild West without regulations. Congress is continuing to work on legislation in the crypto space. Would that negatively impact Tether, positively impact Tether? What would potential legislation look like?
Yeah, that's a good question because there is a lot of attention focused on stablecoin legislation. I was actually in Washington, D.C. on Friday, where I met with some key leaders on the Hill, particularly members of the House Financial Services Committee. And I mean, they are optimistic that a piece of stablecoin legislation will pass in this Congress. And that would kind of help provide some certainty to the industry because it would sort of set terms for like auditing standards, like what qualifies as a stablecoin, what doesn't, who are the authorized issuers, banks versus non-banks, what are the roles of state versus federal regulators, and even more basic concepts such as what type of collateral can be used to back up a stablecoin. All of that is great, but I think it'd be more impactful for companies like Circle and other U.S.-based firms because Tether, again, they're not based in the U.S. and they geofence around the U.S. I mean, they try to stay outside of that market. So that type of legislation may not have as much of a direct impact on how Tether operates However, the one thing that could change is if there is more certainty surrounding how stablecoins can operate, that could encourage big banks to come in and launch their own competing stablecoins. I mean, one big vulnerability in Tether's business model is that when they get these dollars, they pay zero interest and they're free to invest them essentially however they want. So they're sitting on what is essentially an 83 or $84 billion interest-free loan that they then invest in safe assets that provide a 5% return. Uh, and at some point, I do wonder if investors are going to start wondering, why is Tether getting so rich? Why can't we share some of that yield? An answer that Tether and other stablecoin issuers might say is, well, you can take those dollars and then invest them in DeFi or somewhere else to generate your own yield, but that creates an extra step and other risk for the investors. The real challenge, though, is if they start paying out yield, then becomes much more likely those assets become would be termed securities, and that creates a whole other set of issues. But I think the bigger concern related to stablecoin legislation is if, and Paolo actually said this to us when we interviewed him, like JP Morgan, Wells Fargo, the biggest banks in the US, if they decided they wanted to launch a competitor to Tether, they could blow them out of the water in a second. It just depends on if they want to take on that risk and that hurdle.
I'm interested in who these Tether executives are. There's four of them that are now billionaires. You described them as not Wall Street types. Who are these executives? Can you tell us a little bit more about them?
Right. So it's interesting because the mastermind, at least according to our reporting, is the chief financial officer. This guy called Giancarlo Devasini, who, if you look up his official bio on the Tether or BIFNEX website, will paint the picture of a successful entrepreneur. However, some of our reporting and also reporting from the Financial Times has suggested that those claims are vastly overblown, which really kind of makes him an extremely unlikely crypto billionaire because our reporting suggests that he owns more than 40% of the company, which means that at a potential $9 billion valuation, which is where we're putting the value of Tether, if it was ever to be sold, would mean that his fortune is worth a bit more than $4 billion. The CEO is a Dutchman named John Louis Vanderveld, and he operates more as a kind of a statesman working with governments, regulators, trying to open up pathways for Tether. Paolo is the chief technology officer, and all these executives serve as positions at both BitFinex and Tether. Paolo is the chief technology officer, and he really kind of focused on building out the products themselves, but he also serves as sort of the front man, the only member of the C-suite that speaks to the media. And then Stuart Hugner is the chief legal officer, and his take, at least according again to our reporting, would be worth about, I think, $1.2 billion. And but as I said, none of them are kind of cut from what you would expect to be financial billionaires. But at the same point, it bears reminding everyone that so far Tether has passed every single test that they've ever faced as far as redemptions.
So what's next for Tether? It sounds like they are facing some good times right now. Are the good times going to continue to roll for Tether, or will they be facing, additional hurdles, obstacles, anything like that?
Right. So right now, I would expect things for Tether to to sort of stay the course as things have been going. I mean, they just released Q2 financial results, and they were a bit confusing because if you read just the top line, if you read just the top line, it would suggest that the company made about $850 million in profit in Q2, which is a little bit more than half of what they made in Q1, which was about, I think, $1.48 billion. However, we kind of looked a little bit deeper at those numbers, and something did not quite add up because there's really two big inputs when you're trying to figure out the profitability or I guess the revenue generation of a company like Tether that produces stablecoins. One, what is the total pile of investable assets? How much money can they actually put into treasuries, money markets, whatever? And then what's sort of like the Fed's target funds rate? Because all of the assets that they invest in are sort of based on the target interest rate. And for most of Q1, Tether's investable capital base was about $65 to $75 billion. And for the most part, it was somewhere in the high 60s, low 70s. After the collapse of Silicon Valley Bank in March, it went over 80, and it stayed there for the entire quarter. And on top of that, the Fed raised interest rates, or its federal funds rate, twice for a total of 50 basis points. So They had more money to invest, and all the products that they were investing in, all the products that they invested in were providing greater yield. So our estimates suggest that they may have made as much as $1.92 billion in operating profit in Q2. Now, what does this mean? This means that if they're only reporting an $850 million profit, then there could potentially be about $1.1 billion that is not yet accounted for. In the statements that they released along with this attestation, they highlighted how they made some investments in energy companies and also participated in a nine-figure share buyback, about $115 million or so. But that still could leave somewhere between like $800 and $900 million that we're not exactly sure where that went. We reached out to Tether, but they have not answered yet. And one possible explanation is that they paid out a cash dividend to this founding team, because right now they have assets well in excess of the liabilities that they are accountable for in the form of USDT. That would be totally legitimate. It's a company. Founders are allowed to take cash dividends when they have a good quarter, but we are trying to confirm that.
Is that normal where the numbers aren't adding up, and a number that big, I believe you said $1.1 billion is not accounted for? Is this par for the course, or should people's, red flags be raised?
Well, I mean, none of this is par for the course. To be perfectly honest, I mean, for a while, Tether, I would expect that when the company was launched years and years ago, and again, it was started all the way back in 2014. It really took, I would say, like 7-8 years before it kind of hit this kind of mainstream moment. So I would expect that the company has made the vast majority of all of its profits in the last 2 quarters. So I mean, none of this is quite unusual, but there's nothing wrong about it either. I mean, previous concerns about sort of the solvency of Tether really kind of focused on whether or not they had enough assets to account for every single token in circulation. In this case, according to attestations provided by a pretty reputable accounting firm, they still have assets in excess of liabilities of more than $3.3 billion. So if they take some of that off, this $3.3 billion surplus would be net. So that in and of itself doesn't actually raise flags. It just kind of speaks to the moment that Tether is having, and just how profitable this business has been, in what really is a perfect storm of factors.
As we sit here now, we are at the very end of July. What's next when you do an outlook of the rest of 2023 when it comes to Tether?
Right. So, I mean, right now things seem pretty clear sailing for Tether. I mean, they've amassed a massive, I guess, war chest of assets that they can invest in, and the Fed just raised interest rates yet again, and they are signaling that there's a good chance they're going to have to do it at least one more time this year. So estimates that we see as far as interest rate projections suggest that continuing to invest in these different assets is going to be a very lucrative endeavor for Tether. Of course, when you're dealing with a company that does obfuscate from time to time, especially when it comes to transparency, there's always the chance of what we call like high impact, low probability events, or the whole idea of we don't know what we don't know. If it turns out that there is some major red flag with Tether and their holders decide to redeem en masse, that could be problematic. But right now we don't know what we don't know, and Tether has taken steps to do a better job of removing doubt about its collateral and just being a bit more transparent by going higher up as far as quality of auditor and accounting firm goes. Perhaps the biggest challenge then would be, assuming there's no big red flag from Tether that could cause investor angst, is just what's going to happen in Washington with stablecoin legislation, and if that may or may not help Circle or one of the big banks decide to step in and try to take some of the pie. An influential Democratic senator who I spoke with for the story actually told me, he would only speak on background, but he told me that interestingly, regulation tends to protect incumbents in markets, but in this case, the exact opposite may actually happen.
Steven Ehrlich, thank you for the updates. I appreciate you coming on. Thanks again.
Yeah, thanks, Brittany.